Hey everyone, this is Kirk here again at optionalpha.com. This is the first of one of the videos I'm going to try to start doing in a little bit of a series here on option case studies. And the reason I want to do this is because I actually found a trade last couple of weeks that has been really good. I think a perfect candidate for a short strangle, and we don't get this much. And so, especially in the market that we're in with low volatility and the market's just heading higher. So this to me is the perfect opportunity to highlight what a good candidate looks like for a short strangle. So I'm going to do that in this video, and that'll be later. But first I want to cover the short strangle just really quickly for those of you who may be new to options trading. But a short strangle, you're basically going to play volatility. It is a pure volatility play, as I've mentioned before. And what you're going to do here is you're going to actually straddle or strangle the market on both sides with a short call and a short put. So this is a very simple profit loss diagram for a short strangle here, and you can see that ideally you'd want the market to be trading around 40 or so for this particular stock, and you would trade a short put on the bottom side and then a short call on the top side. So again, it does have this quote unquote unlimited loss feature, air fingers quote here, but really the idea is that you take high probability trades shorting volatility when volatility is extremely high. So again, the key here with this strategy, no matter what you do, no matter what direction the market goes, is that you have to trade this strategy during periods of high volatility that go to low volatility. So let's get into the actual stock that I think is a great candidate right now, and that's Tesla. So ticker symbol TSLA. Now Tesla has been on a rampage for the better part of a month now. And you can see on this Thinkorswim chart here from my desktop is that implied volatility has actually gone from the low 20s up to and beyond 80%. Right now it's at about 76% implied volatility, but you can see just a couple weeks ago it was actually up near 100% implied volatility. Now that really never happens, and that's why this is such a good candidate right now for traders. So you can see just the other couple weeks ago was up near 100% implied volatility, and that was back in middle to the end of May. So right now, or I'm sorry, mid part of May. So right now Tesla is still continuing to move higher, but it has kind of calmed down, and implied volatility has quote unquote come down to the 76% range. That's still incredibly high volatility. Now the reason I like this chart right now is because it shows us when is a good time to trade a strangle, but it also shows us when's a horrible time to trade a strangle, just purely looking at implied volatility. And you can see here that I have implied volatility up on the bottom section of this chart on Thinkorswim, and back here in the beginning part of March, you can see implied volatility was down into the low 20s. Now 20, 30, all of that stuff is really kind of relevant just to this particular stock. So most stocks have higher implied volatility, some stocks can have lower. So don't get too caught up on the 20 and 40, but it's the range of implied volatility. So you can see that the range for Tesla back in March, it was at the bottom end of the range. So trading a short strangle like this, where you profit from a drop in volatility, would have been a horrible idea. It doesn't matter if you got the market perfect timing-wise or direction-wise, it's just flat out a bad trade. But right now, it's actually a really good trade, even though the stock is acting a little crazy. You can actually take advantage of this extremely high implied volatility. So let's go here into the actual trade screen here for Tesla. And I brought Tesla up on my Thinkorswim platform. And what I want to point out is how you can find when stocks have higher implied volatility or lower implied volatility given their range. Now, Thinkorswim does a great job of this. You can just look on a chart like we did before at the bottom section of that chart, where you can just kind of guesswork and say, okay, is it trading at the higher end or the lower end? But actually, Thinkorswim does a great job, and they actually give you a number that's called the current implied volatility percentile. And you can see that right now, Tesla is trading in the 70% percentile of its historical volatility. So it's trading near the top end of the range. Now again, ideally with strangles, what you want to do is have stocks that are trading in the 70th percentile or higher, because then you know that the odds and mean reversion and just market cyclicality is going to turn that stock back to around 50% or even lower. So this is where we want to actually be a net seller of strategies. We don't want to buy options. It's a horrible time to buy. We want to be selling in this case. So that's how you find that particular data point. Now let's actually go into the trade and just take a look at what a good trade would look like. Now I've actually kind of highlighted some of these before, but I want to show you guys what a really good trade looks like, or how I would do the actual trade if I was making this trade right now. So here you can see Tesla is trading right at 97.76. And so what I would do is I wouldn't trade it real close to the market right now, but I'd give myself a little bit of room on each end. The key being is that you're playing volatility. You're not making a directional trade, so you do want to be a good distance on equal sides from the market. So you don't want to be $10 higher on one side and $30 lower on the other side. You want to have the market pretty well centered over your strategy. So just for right now, I've picked the 90 puts and the 105 calls. And you can see that together, those 90 puts and 105 calls for June give me a credit of $755 per Strangle. So if you actually think about it, that actually brings our break-even points much wider than the actual strikes. Because most of you right now are probably saying, hey, Kirk, listen, that's great, but 90 is very close and 105 is very close. Even the intraday swings can take us to those levels, and you're 100% right. So by coming in just a little bit closer on the market, you actually take in more premium that allows you to expand your break-even prices. So let me actually show you this by just hitting confirm and send once. You can see on this order confirmation dialog box that our break-even prices are much lower and much higher than the actual strikes themselves. So our break-even is $7.55 lower than the 90 puts, and our break-even on the top side is $7.55 higher than the 105 calls. So that actually takes us out to a price around $112.55 on the top side. Now on Tesla, I'm more concerned about the top side of this trade than I am the bottom side, considering that it's broken out to the top side. So I think that's where the real risk is. But if you actually look here on this pricing diagram, you can see that the probability of it expiring inside of that range, that 112 range, is, let's say, about 16%. So there's a greater chance that the option will or the stock will actually expire inside of that range, that 112 to 115 range, than it will on the outside. There's only about a 16% chance that it's going to break that boundary in the next 20 days. But again, the key here is that we don't care where the stock moves. We want volatility to contract. And so even with a volatility contraction and a big move in the stock, if the volatility contracts, that's where we actually make our money on this trade. So again, the key here with trading these strangles, and I'll go back to the chart here, is that you're not so much concerned about the movement of the stock as you are with volatility contraction. We could easily see the stock go up $5, which would be a huge move in this stock, but if volatility contracted back down to 60%, we'd actually have a winner on our hands and we'd close out both sides. So the key with strangles, as always, and I'll highlight this again in the blog post, high volatility, center the stock underneath the strategy. Take in a lot of credit and close it out before expiration. We're not making a directional trade here. We want to close out the trade as soon as volatility contracts. So hopefully you guys enjoyed this video. This has been a great tool just live right now, a great example of what a almost picture perfect strangle looks like in the market. So I hope you guys take an opportunity to possibly trade this and get this on. And as always, please add your comments and feedback to the video below. I hope to do a lot of these in the future, so I'd love to hear what you guys think and what topics you want me to cover.